So Intel reported earnings last night and it looked good on the surface. The stock was up 10-15%, only to open today and give up all the overnight gains. And actually, I think it's pretty likely that it'll close in the red today. It's actually trading down 3 to 4% last time I checked, and it's not too reasonable, right? Because when you look at the numbers, the stock reported better revenues and actual operating gain from a previous loss last year, last quarter. So the economics are getting better. The revenue growth is there. The potential earnings growth is there. This is quite the opposite setup that we saw with Google. Google reported amazing earnings, but most of the operating income, roughly 200% of it, came from unrealized equity gains. We covered all of that in last night's newsletter. I'm actually sending an Intel newsletter tonight as well, so stay tuned for that. Now, this is quite the opposite because the stock had better operations and still delivered a net loss for the income statement and negative EPS. So we're gonna get into all the numbers and where that loss came from because it doesn't really make any sense. So the operating business is doing good, and this is one of the scenarios that I liked last year when I pitched you Intel stock around $20 a share. It's very public in my Twitter account and on the newsletter as well. So feel free to check out that thesis. Now we are seeing a positive operating income. We are seeing the revenue growth that I was expecting last year, right? We have 25% revenue growth, 40% gross margins, up 12.9% compared to last year. We have 1.8 billion in operating income compared to a 3.2 billion dollar loss, and 42 cents in non GAAP EPS. So this is adjusted EPS. So they actually turned a profit. Now, even though these are great news, I want to avoid the stock because I believe it is all priced in at this point. When it was at $20 a share last year, I think that the opportunity was very obvious. Now that the stock is over 100, at 5x from my entry point, and all the positive fundamentals are here, I don't see why anyone would buy this name right now. And even after all of that, the operating profit, the positive non-GAAP EPS, the 25% revenue growth, and the AI adoption and everything, why is the stock down, right? And that's what we're gonna get into today. And there are four reasons I believe why Intel is down from the earnings. First of all, it is a concentrated market in an industry that is slowing, right? So roughly 59% of all revenues at Intel, the ones that really grew, were coming from data center and AI. Now, data center construction is slowing to a very weak level that we're going to get into in a later slide. But essentially, I don't like that concentration. I don't like the fact that every other business segment within Intel is not looking strong at all. It's actually very weak. Now, the second point is profit is up and guidance is down. So when you look at the management guidance, they're actually guiding lower for next quarter. Now, I know everyone will tell you that this guidance is actually very positive and very bullish for the stock, but that is when you look at the reported EPS. When you look at the non-GAAP EPS, the guidance is actually down. So I believe the market is selling off on these missed expectations moving forward from the management itself. The third point is that they posted an $11 billion loss on government shares. So we're going to cover the escrow shares that the CHIPS deal had for Intel and the losses from redemptions and everything else that's happening in the cash flow statement that I bet most of you missed. The fourth point and final one is that Intel is issuing a lot more debt now, just like Google did. So that not only spikes interest payments, but the worst part is that they're using this debt to fund partner payouts. So they're a partner with the US government. We're seeing that loss of redemptions and assessing the new shares $11 billion lower. And now we're seeing the effects of funding partner payouts to NVIDIA. So NVIDIA is doing the circular financing deal with over 100 entities now. Intel is one of them. So every profit, even if there isn't one, has to be turned over to NVIDIA. And this is what we're seeing with Intel right now. So let's go over issue number one. The profit center is data centers and AI. And we can see the bridge of revenue here. So Intel products, which includes the data center and AI products, were up or generated $4.8 billion in revenue for this quarter. Intel Foundry, which is really the main business, that's what Intel is, a foundry. They lost $2.1 billion. All other products, like hardware and everything else in the cloud and what have you, it went up or generated $0.2 billion in revenue. Everything else, corporate and allocated revenues, went down or lost 1.4 billion in revenue. Now, the only growth engine that is happening at Intel, and the only reason why the stock shot up this much over the past year, is because of data centers and AI. Now, when you strip that out, let's say that we stop building data centers, we stop having so much demand for data centers and AI products from Intel specifically. I'm not saying industry wide. I'm saying that maybe a competitor comes in and they can do it for cheaper, they could do it for better. And then that competition comes in and kicks Intel out of the spot that it is in right now. What happens to the actual business? Well, there you see it. $2.1 billion loss on foundries, barely anything on all other products, and unallocated losing 1.4 billion as well. So, I mean, I don't see how Intel can stand up on its own when and if the data center and AI trade cools off. And in fact, it is doing so right now, which is another reason why I believe the stock is trading lower. Now, let's go over the actual numbers for data centers, right? So this is a study done by the LSEG, and it covers both the spending levels and the annual construction growth for data centers. Now, we were over 20% growth and 80% 80% growth and $20 billion invested into data centers over 2026 and 2025. Now we are headed lower to below 5% growth and marginal amounts of investment going into data centers. So all this to say, and you can look at this study by the LSEG, that the revenues that Intel is posting from the data centers and AI, such as other companies like Nucor, other companies like GE Vernova, we saw the earnings reaction this week as well. Not good, guys. This is not good. When you stop investing and stop growing the data centers, all these companies that were so-called bottlenecks that rallied massively based on that narrative are now selling off. And they're selling off because they can't sustain the higher valuations because the assumptions are being proven wrong. They were proven to be too overly aggressive. And that's what we're seeing today. Now let's get into issue number 2. The EPS, when you adjust it, is higher, right? They reported roughly 42 cents on EPS. But management, I think because of the previous point in data centers and the fact that Intel on its own, the foundry, the other revenue businesses and segments and revenue streams, they're not going to stand up on their own without the data centers and AI. And as we just covered, the data center spending is down to less than 5% year on year. So what happens to the overall business? I mean, management at least has some realistic idea of what could happen in the future. And they're bringing that expectation down to next quarter itself. So they're guiding for a lowering from 42 cents in earnings this quarter, this is adjusted earnings, down to 34 cents next quarter. So again, I think that management is looking at the fact that most of the revenue growth and most of the operating income is coming from data centers and AI, which is a business and a segment in the industry that isn't getting as much investment, as much growth as it used to. So at least they're being realistic around the fact that maybe that's not going to work out. Now let's go to issue number 3. There is an $11 billion loss in one government item. And you can see the bridge here in EPS bringing us from a $2.16 loss up to a 42 cents gain. And that big green bar is escrowed shares, right? So what are escrowed shares? These are the shares that are held by the U.S. government under the CHIPS Act deal. So what happens is all these shares make up higher valuations, they make up lower valuations, but it's not based on the open market. It's based on the private valuations in the private market that basically all these private equity players and government players place on Intel. So the fact that these shares are losing value could be due to either reassessment of the value or redemption of these shares, therefore losing the value of that account. This is very complicated, and I don't think that Intel should be that obscure about what they're doing with these escrow shares. But That's just the way it is. Just like Google decided to be more complex around reporting unrealized equity gains. Now, this is not a one-off, guys. If it was a one-off, I'd be the first one to tell you that Intel is a buy, because they actually reported better earnings, better operating income, and a positive EPS number. But the fact is that escrow shares number is going to keep showing up until the stakes from the government are out, until they liquidate, or until there's going to be a spinoff or a pipe deal, right? Private investment in public equity sort of thing, where they swap out the government stake for somebody else's stake. And I don't see that happening anytime soon. So again, that's not going to be a one-off event. Now, when you read the cash, you have an $11 billion loss and $7 billion in operating cash. So this is good, right? This is overall positive for the company because they actually generated $7 billion in operations. This is going back to the point of the operating income in the income statement. It's positive. They have better economics. The revenue growth was great, leading them to $7 billion net. Now, when you adjust for these losses, which are, again, not a cash outflow yet, but something that Intel will have to pay down the line, it doesn't look that great, right? And then there's the fact that revenue was concentrated in the data centers and AI space, a space that we've proven to be slowing. I don't think that we should celebrate that $7 billion in operations just yet. Again, if this was any other company, any other type of setup, any other type of financial makeup, and I'd be telling you that this is a buy, right? So now we get into the fourth issue, which is that Intel is issuing debt to fund partner payouts. And this is not just the US government, it is NVIDIA as well in that circular financing issue that I've brought up many, many times for other companies as well. So let's look at what they did in the financing operations section of the cash flow statement. So they issued $13 billion in debt. That all roughly went into partner distributions, right? So when you look at how much they issued and how much they repaid, that's roughly $4 billion. Then they had partner contributions of $4 billion. So that's essentially more US government stakes, equity stakes going into Intel, or NVIDIA equity stakes going into Intel. So you have roughly $8 to $9 billion of cash in hand from both equity injections and debt issuance that all went out to partner distributions, right? So this is maybe paying off an older stake at a lesser valuation made by NVIDIA, made by the US government. So again, they're paying out a lot more than they're making, right? Twice that $7 billion from operations I mentioned, $14 billion were paid out to partners. So essentially, you're giving your money to Intel to give back to NVIDIA and the US government, which is, again, destroying shareholder value. And when you look at it, they're only investing $2.6 billion into CapEx, right? So Google is getting punished because they're doing too much CapEx and misleading the investors on how they report their earnings. Intel, I think, is getting punished because they're doing no CapEx, right? So zero CapEx, and they're essentially giving all the operating income back to their partners, which are NVIDIA and the US government, which, again, I don't know how you feel about this, but me, I don't think this warrants an investment anytime soon. Now, we covered all the four issues, right? Let's go over what happens to cash. Now, cash is falling, debt is rising, obviously, which leads to negative free cash flow. It leads to a bunch of missed allocated capital, and it forces Intel to keep issuing more debt and equity. So they issued about 1 million shares over the past quarter. Again, diluting you. They issued $13 billion of debt, leveraging up the balance sheet, leveraging up the stock volatility. And what are they using all that money for? So they're diluting you, again, to pay back NVIDIA stakes and pay back the government stakes, not to actually invest into the business, because why would they, right? If data center construction and tokenization demand is falling 20% month over month, why would they keep investing, right, into the actual business that is making money? Because tomorrow it might not do so. Now, the two giants here are quietly draining Intel's growth, and that is the government and NVIDIA, as I mentioned before. And that is, I think, the bigger picture, not just for Intel, but for all the companies that are involved in this circular financing shenanigan or mass fiasco, whatever you want to call it, with Nvidia. So the more companies that take stakes from Nvidia, and the more dangerous their operating income becomes, I think they're going to be wiped out of the market, just as Intel is getting treated right now, because whatever profit, if any, they can make in the future, most of it will have to be paid back into Nvidia. So again, not a great place to be in right now, and it tells you a lot about the AI trade. Now, there's one more tell here, and that is that the balance sheet is quietly telling you a message that most, again, will sadly miss. And this is the cash conversion cycle. So when you see all that discrepancy between the cash flow statement, the income statement, and how much cash is really going out of the business versus what they reported, you can catch it all in the balance sheet ratios, such as the day sales outstanding, which is 23 days, days inventory outstanding, 118 days, days payable outstanding, 83 days, all combined for 58 days of cash conversion. Now, companies that are able to manage volatility in the markets, volatility in their own business cyclicality, they have a negative cash conversion cycle, meaning they tend to have cash on hand month after month after month. Now, Intel essentially has a positive cash conversion cycle, which means they don't carry any cash any given month of the year. That is dangerous, to say the least. So if anything happens to the data center business, if anything happens to their NVIDIA financing or government financing, if they don't take in any more injections or they have to pay out more than they earned, they don't have any cash on hand. So they would have to quickly liquidate any cash available. They would have to liquidate any assets, short-term assets and liquid assets that they have, or they might as well just keep issuing more debt and equity, diluting you further. So having a positive cash conversion cycle is not always bad unless you find yourself in a situation like this one. Now, you decide what you do with Intel. I'm not going to tell you to buy it, short it, or ignore it. I'm just giving you the information, right? What I'm doing about this, though, is finding out that on a day like today where Intel is down, Broadcom, Micron, SanDisk, NVIDIA, all of them are down. Software stocks like Adobe, Workday, Uber, and Microsoft are up. So that should tell you all you need to know about where money is going if all of the AI trade continues to slow down. We're already positioned for it. I update the portfolio for upside every single morning in our morning digest. I suggest you check out the newsletter below. Sign up for it. It's free. I'm going to give you all the information you need on a thematic basis for you to act on it and eventually miss the down days that happened like today in Intel and Google and all the names that are reporting. Now, here we go. A record quarter goes backwards for owners, and that is the closing statement for this presentation. We have real operating profit, real revenue growth, but at the end of the day, the revenue is coming from a slowing end market. We have lower EPS guidance for management after they realize that revenue growth is essentially a one-off. And then we have leaking cash and equity, as they have to use everything to pay back NVIDIA, to pay back the government, and they just keep issuing more and more debt and more equity. Again, that's not a business that I would choose to be in. I'd like to have high quality balance sheets, high quality cash flow, and high growth businesses that have none of these accounting risks, all of which are going to be pitched out in the Offside newsletter. Again, check it out below. I'll give you one such example. I'll link back to the Adobe deep dive that I made about 2 months ago. We executed that by 205 per share. The stock is obviously up, so we're pretty happy about it. Other than that, that's all for tonight. Enjoy your weekend. I sure will tomorrow. Taking a rest from all the volatility and be ready to go next week for you guys. Catch you guys in the next one. Enjoy.